Welcome to this webinar on strategic risk management. My name is Nathaniel Imprim. I'm GAMFIN's training coordinator. So today's webinar is hosted by GAMFIN and CAPLAS through a partnership with MasterCard Foundation to strengthen Ghana's non-bank financial sector. The program is called FIRST Plus, which stands for Financial Institution Resilience and Strengthening. Now to our presenter. Donald Neal is a seasoned development, finance, and risk management specialist with over 20 years experience working with both bank and non-bank financial institutions throughout the world. Ms. Neal's assignments have included assisting the banks or non-banks during critical and crisis situations, specifically to develop useful practice, policies, and tools to assess, measure, and monitor risks. Madam Donald, please, the floor is yours.
Thank you, Nathaniel. Welcome, everybody, and welcome to the people that I returned to this third of 4 webinars talking about risk management. I appreciate Nathaniel calling me seasoned. And I was smiling because I wanted to admit something to all the participants today. Even though I may look quite young on this video, I'm actually quite old, or I have lots of experience. And the reason I'm saying that is I've been working in risk management over 20 years. And this risk, the strategic risk, is pretty new. I have to be quite honest. About 20, 25 years ago, when I had started as a little risk manager, we used to have something called business risk. To be quite honest, we weren't that focused on it, nor were the regulators I worked with. They were more focused on interest rate risk or IT risk. Honestly, because IT was really rolling, the online platforms was starting to be rolled out in the US. So that was the big risk back about 20, 25 years ago. And there was no discussion about strategic risk. I think after the crises, the economic crisis in the US in 2009 and 10, the economic downturn, there was more discussion. And I've noticed actually since the pandemic, a lot more discussion has come about. So, I'm presenting some information, some prudent practices. I'm going to be sending some handouts to you about this, but this is a pretty new risk that we can discuss. And so we'll discuss this in detail of how to look at this. Sorry, I've got to figure out. Okay, so let's start out with what is strategic risk? I found one of the best definitions was actually by one of the regulators in the United States. They defined it as the risk to current or projected financial condition and resilience arising from adverse business decisions, poor implementation of business decisions, or lack of responsiveness to changes in the banking industry or operating environment. So there's 3 areas there that they talk about. As you see, I colorfully highlighted them. So, one is making a bad business decision, or one is the bad implementation of a decision, okay? Or you can have the lack of responsiveness to the change in the banking industry. For example, in the US, to be actually competitive now, you absolutely have to have an online e-wallet platform that's pretty decent. That's very good, because that is just, compared to 20 years ago, which all I had was I could look at my savings or my checking account. I couldn't really move money back then. I couldn't do anything except just look at what was in my accounts, period. So now you have to have the capability to move money if needed, do transfers, and a lot of other fancy stuff. So if you were a bank and you stayed 20 years ago and only be able to, I could only look up at my accounts, what was in my accounts, you wouldn't be competitive in the US and probably not have a lot of clients unless you offered something else very special to specific clients, like, you know, huge interest rates on the savings. So sorry. This, I'm trying to see this. The strategic risk can arise from decisions made by leadership. So that can be internal, or it can be from an organization's position in the environment, something external. I mean, your position, your bank's position, your financial institution's position can change rapidly in the environment because your competitors could hop ahead, have something incredibly innovative that will leave the rest of the banks behind. So it could be internal or it could be an external factor. So let's look at the overview of the risk, the risk framework, risk management framework. You have on the top, you have corporate governance, right? Overseeing the board that's overseeing everything, and also decisions by management. They will dictate your policies, procedures, and practices. And on the bottom, you have people, training, and cultures. So as you know, you could have excellent policies, procedures, and practices. But if people aren't well trained and don't have the similar viewpoint as you, as management has, as the board has dictated, it could lead to a disconnect within your risk management framework. There are many, many times, I will be quite honest, I go to a financial institution, I sit in the head office, and I talk to the board, I talk to senior managers, I look at their policies, everything is excellent. Everything is very good. They have a strong risk culture. I really understand it. And then I go out to branches, I go to 2-3 branches, and I realize these people, there is a total disconnect between the branches and the head office. You know, what they were not, that we were doing utterly different things, but their beliefs and what they thought type of lending should be done was a bit different than the head office. So if you don't have that connect between the people and the policies, procedures, and the practices, beliefs of the corporate governance, that could cause a major problem. And then between here, you have the risks. We have the credit risk, right? We have the financial risk, we have the operational risks. And those are going to be governed by the policies, procedures, and practices. You have capital adequacy. That's kind of a layer above that. It kind of dictates a lot, right? We have to keep a acceptable level of capital for the regulators. And this is where we get these more qualitative, they could be very qualitative risks, the reputational, legal, environmental, strategic risks that can just funnel through and impact everything. Meaning it could impact your capital adequacy, and then it can impact all your other risks underneath. So you have your very specific risks, the credit, financial, and the operational, right? The ones we've talked about, well, we talked about the financial last week and the week before, but then you also have these other, we call it reputational, legal, environmental, strategic, kind of sitting on top of the entire organization. So strategic risk is made up of a lot, and we're going to discuss this a bit because I got to be honest, since this is actually a newer risk, I mean, something honestly that's come out probably in the last 5 years, more discussions. I would say 10 years it's being discussed, but in the 5 years it's getting more clear. And our regulators that I've seen around the world are actually dictating that this has to be something that's discussed and mentioned in the risk plan. So strategic risk has many risk areas, but I wanted to show this chart. This is from one paper I looked at. It talks about the top risks to strategy and objectives. And I have circled here some things. You have customer risk, right? All of a sudden your customers leave you, right? That you are not keeping up with products, or you do something to scare them away, which we'll talk about. We have some examples. You have innovation risk, right? If you're not innovative, then you're going to be behind the pack of your competitors. However, If you do an innovation and you don't implement it correctly, then you could lose money and it could be not useful. And unfortunately, I've seen this risk a lot with financial institutions I know that have had their IT department or their IT or who their consultants they hired weren't qualified. So there was additional money going in to develop this innovative product. Now, it wasn't enough to kill the bank or the financial institutions, but it hit the bottom line. You also have the planning risk. If you don't plan out, if you're just living, if the financial institution is only taking 3 months out when it should be really thinking a year, 2 years, 3 years, probably 5 years out. You want to see a strategic plan that's at least 3 to 5 years out, things where we want to be and what we want to look like. So I'm not going to go through all these risks, but I wanted to just discuss to show you that there's many, and let's talk a little bit more. I want to kind of talk about strategic risks versus operational risk. There is a lot of confusion out there that I've read and that I've seen and that I've experienced when I go into financial institutions, a little bit of confusion between strategic risk and operational risk. So let's talk about the differences. So operational risk is the risk of losses arising from inadequate or failed business processes, employee errors, or cybersecurity events. They can be human error, systems failure, an inadequate internal process, a data breach. Okay. What is important, or what I should say, one of the characteristics of operational risk is the effects are felt immediately. It's like a punch almost. When you have a data breach, you know that, oh, it's gone. Like that now that one financial institution had a email come in and somebody employee opened it up and it wasn't secure and it let out a virus. I was sitting at a bank and literally they had to shut down all their MIS and IT programs for about 3 hours until they cleaned it up and figured out what happened. It was immediate. The effect was immediate, but luckily it was only 3 hours and they were up and running again. Now let's talk about strategic risk. Strategic risk is more long-term. It is a risk that prevents the organization from meeting its strategic goals. Okay, you can have some unclear business decisions. You can have a new product introduction, like I said, that doesn't work. You could have some changes in senior management that are impactful to implementing your strategy or your business plan. You could have financial challenges. You could have some change in competition. So what about these is, again, the effects are more slow burning. For example, a lot of times I will talk to organizations about succession planning, right? And we will talk about with the board that, you have your maybe 5, 6, 7 key managers, executives in your financial institution. And we talk about the impact if one of these key managers was to leave, especially if it was a founder, somebody who found the organization, had been there a long time. And it's interesting, I get the same answer from a majority of boards. Oh, well, especially if the CEO left, we have line managers like the finance department, we have the lending, they're fine, they'll operate, right? And they will. But what about the long term, especially if it had an impactful CEO? So, for example, I was went in to do an assessment of a bank, actually, in the US. And what I found out over the last year, the CEO was literally hit by a bus. I'm not kidding you. We say this kind of as if you were hit by the bus, but she was hit by a bus. She's fine. But because of her recovery time, she needed to take 6 months off from working. And During that time, the board stepped in to help implement the business plan. You know, the CEO was still there and the other senior management team. They were fine. But what happened during that time is it was a strategic risk. The operations continued. The financial institution didn't grow like it expected. It didn't expand like it expected, and it couldn't introduce some new products like it expected. It just stayed the same, and it was fine. However, because the CEO was the person pushing and also behind a lot of these changes in the growth, it wasn't being implemented. So the CEO being gone for 6 months, and it ended up being 9 months, actually hurt the institution to implement its strategic goals. So let's talk strategic risk, and let's talk Silicon Valley Bank, which continues to be one of the largest, one of the big discussion points in American newspapers and international financial newspapers. Let's just have a little bit remembering that it was closed by the US regulators on March 10th. And the big discussion right now that I've been reading about is what killed the bank, and specifically which risk killed the bank. You know, everybody's grasping to understand this so it doesn't infect other financial institutions, because we had a couple more banks that have been taken over by regulators since Silicon Valley Bank. So let's discuss which risk killed Silicon Valley Bank. As we remember, the bank's management, with approval of the board, decided to fund its long-term assets, its investment portfolio being bonds, with short-term funds, meaning deposits. Deposits that at any time the client could come in and ask to withdraw. As we remember, 90% of the deposits were from large corporate clients. Thus, they were not fully insured by the US regulators. And as we also know, corporate deposits aren't, as we say, sticky as consumer deposits. It's less likely that somebody who has a few $100s is going to be moving that deposit very quickly compared to somebody who has maybe 500-600 million in deposits at a bank. So this is an interesting fact. They started to unwind some interest rate hedges in 2022 as management thought interest rates would not increase further. For people who may not know, hedges are a way to kind of, it's like insurance a bit, I guess we can say, insurance against changes in interest rates, okay? So if the bank had a big bond portfolio, as they did, and they had hedges in place, they kind of had an insurance policy if insurance rates went up and the bonds portfolio value went down. Okay, so let's just say they had insurance prior to 2022. However, they started to unwind these hedges and they were able to, because they realized some huge gains, they earned revenue. And guess what? Because their revenue was looking so great, and partially because they were unwinding this insurance policy against the interest rates going up, they had some nice bonuses from management. And when I mean nice, I mean I could retire on these type of bonuses they were receiving. But then they needed cash and they had to liquidate their investments at a loss. So, and the result is, we remember, the clients got scared and started withdrawing the deposits. $42 billion was withdrawn in one day. And the next day, the bank was taken over by the US regulators. So, again, let's remember what the regulators say. The risk to financial condition or resilience being able to continue can arise from adverse business decisions. And again, I think we can say the board and management made some bad, very bad business decisions. So as we were thinking and talking a few days ago, a few weeks ago about was, Silicon Valley Bank, was it liquidity because all of a sudden everybody withdrew? Was it because of, their capital, because maybe they started showing losses and it impacted their equity position? Or was it a governance risk? Well, it probably was somewhat a governance strategic risk. Some very bad decisions that were made by the board and management. Some other specific examples to think about when understanding what strategic risk is, like I said, you can have an introduction of new products or services by a competitor that will just push them ahead and you will be way back. It could be an unsuccessful merger with a bank or another financial institution. You can see like evolving customer demands for digital products and not being able to keep up with the client's needs, as I discussed. You can have the departure of an important management person, such as like a chief risk officer, and no replacement for 9 months. This actually happened at Silicon Valley Bank. In March 2022, their chief risk officer departed and they didn't get a new one until January of this year. And 2 months later, they were closed by regulators. So you just have to wonder, if there was no chief risk officer, was there some misses, some lack of monitoring or understanding what the risks were? I don't know. I wasn't there, but you have to question. A damage to reputation because of losses. Again, this happened to Silicon Valley Bank. They started showing losses, and then their people were taking out their withdrawals or their deposits. There was poor cash flows or other financial challenges, could also be an example. Changes to the competitive or industry landscape. Like we said, as maybe a merger of two rivals into a single large institution. This actually happened a lot in Chicago. We saw, this is about 30 years ago, you saw a lot of banks merging and the little ones were left behind. They weren't able financially to keep up with the innovation that was moving ahead with the larger banks that merged. And unfortunately, a lot of banks then had to say, okay, you want to buy me too? And that's what happened. A lot of banks were taken over by other banks. And here's an interesting one, an online fraud that occurred to multiple accounts, and then your call center's overwhelmed. So what happened, and this happened in Great Britain, that there was all of a sudden at this bank, and this bank mostly had consumer deposits. Okay, so mostly, individuals as clients, and there was a breach. But what was interesting is the breach was that on the IT system was that only about, I think, 100 pounds, right, was missing from accounts. So not a lot, but a little bit of money. So when we're talking thousands and thousands of clients woke up, you and me woke up to realize, 1,000 pounds or $1,000 is missing from our account. And of course, what happened? I'm going to call the bank. And guess what? The call center got overwhelmed and people weren't getting their answers. And then there's reputation risk and people were very angry and people were, and at the end, they lost a lot of deposits because of it, because they weren't ready for the number of calls that they were going to receive. And they didn't have any way the clients could effectively also contact online to try to get answers of where's my 100 pounds. So let's talk now about managing and monitoring strategic risk. So the first thing that needs to be done is you need to understand the organization's business objectives and strategies. to start thinking about what the strategic risks are. I know that sounds like well, that's obvious type of step, but it really means that anybody who's going to be thinking about the strategic risk management, the board, the risk team, even the business line, people that may be looking at strategic risks really need to look at the objectives and the strategy moving forward, the 3 to 5 year strategy. And then we got to create a risk profile, or kind of, we say a risk identification, because we need to think about the top risks and rank them by potential severity. We can do this with interviews or surveys, and I'm going to talk to you in the next slide about how to think about these risks and then how to rank them. And then you validate this risk profile. You know, in a perfect world, you would have a huge team of people thinking about strategic risk and coming up with this risk identification. In the real world, not, 10, 20, 30, 40, 50 people, including board members, senior executives, business line people, have the time. So what you're usually going to have is a small team of people that are going to develop this risk identification, this risk profile, but then they're going to go validate it and discuss it with other key executives and board members, maybe that weren't able to participate. And then you're going to develop your plan, your strategic risk plan. I will talk to you about what that means, what should be included in your plan. And then you're going to communicate strategic risk profile and the plan to stakeholders, which means the board, the management, the line managers, to make sure they understand we're all on the same page of what this means. And then you implement a plan, and you'll be monitoring whatever tolerance levels you have. But we'll talk more about tolerance levels in the next few slides. Okay, let's talk about this risk identification risk profile. So, ways to identify the organization's strategic risks. You can do brainstorming, which is like a group of people, some senior management, maybe some board members, the risk team, even some line managers, work together to identify potential strategic risk and determine which risk mitigating controls are required. You could also just interview or do some key survey to stakeholders meaning the board members, managers, to identify strategic risks. I am giving you a handout that you'll be receiving later. That's actually some interview questions that I found that were, I thought, very good if you want to do more of a survey type of risk profiling. That you can go around and ask the same questions of board members, some senior managers, some line managers. I think a mix of both actually is your best way to do this. So maybe start out with, forming a group that you're going to brainstorm with, planning your meeting that you're going to do this at 2-3 hours. It's going to take a while. And then beforehand, the risk team should go out and do some survey or interview some board members and senior executives that won't partake. So then you can use the survey results with the brainstorming group to kind of develop this risk profile. And you can look at it a couple different ways when you're thinking of your risk profile. You can think of scenario analysis, okay? Or you can, the next type of thing you can do is work backwards, right? For example, you can say, what would cause a run on our deposits, meaning a huge withdrawal? What amount of deposits would have to happen to impact us that it would be a medium or high risk scenario? Okay, and then you develop the scenario. What would happen to make a run on deposits? Here is, I found from one of the papers I was reading, very interesting kind of graph that after you come up with these scenarios, you should try to understand the impact and likelihood of the scenarios. So if we look at this, if we look at maybe the First, it's number one, if you can see in the upper left, risk scenario is a stolen credit card fraud, right? Likelihood, as we notice on the left, is monthly or frequently. This is happening frequently. However, the impact is minimal, right? If it's only happening to a few credit cards. But this was for an example from a bank that would have, but you can see on the bottom to the right, things that happen less than 1 in 25 years would be a liquidity risk, a bank run. Now, this paper was a few years ago, and as we know, we had a run for a California bank, Silicon Valley Bank, just recently. So it actually is probably, I think, more likely than they put it in here. An earthquake, they said, if you look at number 2 for severity in California, and this is affecting this chart was done for some California banks, is less than 1 in 25 years. And the severity would be huge if there was a major California earthquake. So what I'm saying is, after you develop your scenarios, when you're thinking of your scenarios, actually, you can draw this type of chart with the likelihood on the left, the impact on the bottom, and actually chart these scenarios out as you're discussing with your team that's thinking about strategic risk, to understand, the likelihood and the impact of the scenarios. It's very important to think of the likelihood and the impact. So let's talk about developing your strategic risk plan, okay? The first part is you've developed the scenarios, right? You got to talk about what the future could look like. You got to talk about these the issues and the risks that you identified. What are the driving forces and critical uncertainties? And you got to describe these scenarios, right? So you're not going to be able to take every potential scenario to put in a plan. You probably only want to really put the highly impactful and maybe the more scenarios that would happen more often in your plan. Because if we're going to put every scenario in a plan, your plan would be hundreds and hundreds of pages. And really, a strategic plan should be no more than 25 to 50 pages. And you should take a few pages to describe each of these scenarios. And you're going to discuss the consequences. What happens if there was a natural disaster, and how would that affect your financial institutions? And then you're going to determine some leading indicators or measurements that would talk about if this became a medium or high impact type of event. For example, in one country I work in, they have lots of rivers, and there are a couple of rivers that are prone to flooding. And we normally, the floods are not impacting cities and towns. However, I would say it's been happening about once every 10 years that one of the rivers is overflowing into some of the major cities. And about 10 years ago, it impacted about 3 or 4 of our branches, where 3 branches were underwater and 1 branch was heavily impacted. So they hadn't planned out how to react. They did well with reacting because they went out, assessed the impact to the branch. Then they quickly went and met with all the clients to try to assess, is the businesses still there? Because this was a business lender. Are they going to be able to pay back? And then they quickly, within a month, assessed, or not within a month, within a week, came back and assessed, how many clients they thought were actually out of business, how long some of the other businesses would take to get back on their feet. And then they went out 1 month later after they let clients, they actually went out to clients to meet them and gave them like a basket of things to help them some food and some things saying, we're sorry this happened to you, and we're here and we're going to contact you in a month. The reason they were taking the baskets was, they wanted to be kind to the people that have suffered through this flood, but they also wanted to assess where that business was, and it gave them opportunity to meet with the client briefly to assess it, to come up with the likelihood and the impact that was going to happen on the bank, how many loans actually were at risk. And they went out a month later to do a full assessment. Now that they've did that, and they had to come up with that plan very quickly, they've implemented a plan to deal with any kind of environmental impacts, because also this country is prone to earthquakes. So now they have a plan that they've implemented, like a strategic risk plan for environmental impacts of earthquakes or floods. But you also can have some leading indicators on business decision plans, and I'll talk with you, and then you can have a dashboard or maybe even a heat map, high, medium, low, to decide if you need to take some steps, some actions right away. And then this is what I'm talking about. Depending on the risk, high, medium, low, then you can discuss what your response would be. So this would be in your strategic plan. So what are some strategic key risk indicators? Some of them will be financial, like your budgeted return on assets or return on equity, your net income, growth plans, maybe portfolio growth plans, delinquency charge-offs, okay? These are things you can monitor that your institution should have set, saying, this is where we want to be in 6 months. This is what we want to be in 12 months. And then it should be monitored on the dashboard. And if you're missing it, meaning you're not hitting your return on assets or your net income plan or your portfolio growth plans, if it's off by a little bit, then it's not huge strategic risk. But if you find that you're off substantially on maybe your loan portfolio plans, which is going to hit your interest income, then there needs to be a discussion being held at the risk management committee or at the senior managers meeting. Also, like delinquencies, if all of a sudden you have a minimum amount of delinquencies or charge-offs you're allowed in the institution, and all of a sudden it's a spike, then a discussion needs to be had again at your risk management committee meeting or between risk managers, maybe even at the board level. Staff turnover, loss of senior managers. This could also be an indicator. I have one institution that for some reason have had a huge staff turnover. And unfortunately, they're located in a place that it's very difficult to find staff. There's migration from the major cities. So it's a big strategic issue for them, finding qualified staff. You could have a loss of a senior manager that could be an incident also. You could have some significant events or cumulative, and let me explain that. So you have some operational loss incidences, right? And for a bank I worked with, I remember this, for their teller, they had tellers, and for the drawers of money, right? There was an allowable amount monthly that could be missing from the teller box, okay, cash. But what they found when they started looking cumulatively, there was a significant amount missing from, if you looked at all the tellers at all the bank branches, like this was becoming a huge issue, and it could, it was growing. So that's when what happened was the risk committee realized we have this risk that's going to impact us financially. We need to understand what's happening. They formed a committee, a specific committee to look at what's happening and come up with some new policies, procedures, and training for tellers to ensure that this amount, this limit was decreased on the cumulative basis. You could also have fraud that, maybe it's just a small fraud, but cumulative, if you see that this fraud is happening, that maybe your clients are committing this fraud and it's the cumulative, it's large, it means it's something that strategically needs to be looked at and changed. with your clients. Maybe there's some process or procedures that are not working, or it's something larger like a product that you've developed that maybe is allowing some fraud where it should not be. I saw that with a lending product once that wasn't fully, it was supposed to be quick, get the money out the door to the client. However, it didn't allow for let's say a appropriate amount of underwriting. And so they were letting the money out the door before they properly underwrote the client. And thus they were giving some loans to some people that never intended to pay back. And they saw an increase of fraud, people taking the money and not paying back. And then they realized this was actually a product design defect that they needed to change. Could have a natural disaster, as I talked about, that could be an indicator that you have a strategic risk and you need to think about. And you can have some regulatory compliance, or I should say non-compliance, that would say there's something going on. If you're non-compliance with a regulatory requirement, that is a huge red flag about a strategic risk. You don't want to ever be red flagged by the regulators. That's the biggest no-no in banking and in the financial world, as we know. Here's some examples of some financial indicators from a bank that I knew and I worked with. I just wanted to show this to you quickly. They were looking at their return on capital, some other solvency, and then their liquidity to look at what their target and what their actual was for, and then the contribution to the target in 2015. This was in their strategic framework. So we're getting to the end, and I want to talk about some good practices. You should require coordination across all levels for strategic risk management. Normally, you should assign a senior person to be the point of senior accountability. I found that works best because if you don't have a person kind of championing this, it could be lost in the cracks with daily business. You should have you could create a strategic risk committee, Stratco, to be looking at this and meeting quarterly to discuss this. You should assign some strategic risk owners within the business lines. And, you should train your risk leaders in forward-looking risk management approaches. Unfortunately, I think risk management until 10 years ago was always backward learning. That's how I learned it. We thought about what had happened previously. We always looked at, past indicators. I was not trained to look forward, and it's taken me a lot of time and a lot of training to be able to think on strategic risk and think about the forward risks that actually can be really detrimental to an institution. You got to establish a strategic risk management approach, meaning you should have a committee. It should be discussed. There should be indicators. You should be persistent in developing the scenarios. As I found working with some institutions, some members that are supposed to be developing scenarios are not as collaborative as shall we say, as others. So this is why you got to grab a bunch of people, get them in a room, have them turn their phones off or have them put them on silent and really start developing those scenarios. The plan should be updated minimally annually. But the strategic risk indicator should be reviewed monthly by management and quarterly by the board. You should have a strategic key risk indicator dashboard for the board. So I will leave you with strategic risk with its underlying driver of changes in the banking industry and operating environment requires banks, financial institutions to step away from history and consider the ways in the future that can be fundamentally different. What can change? What can change to hurt us? You got to keep asking that. And at that time, I just want to thank you.
Thank you. Sorry. Thank you, Donna, for an awesome presentation. It's been a good series we're having on risk management. This is the third of it. We have asset liability by risk management, we have liquidity risk management, and today we are having strategic risk management. Some note that I took down was a definition of risk management given by the US regulator, which defines that the risks to current or projected financial condition and resilience arising from adverse business decision, poor implementation of business decisions, or lack of responsiveness to changes in the banking industry. Thank you so much for, so please, I want to encourage everyone, if you have a question, you can post it on the chat box and then we will follow up. Donna, the quick one on the question. So we want to find out what is the lesson learned from the strategic risk viewpoint on the Silicon Valley Bank case. What is the lesson learned from that case? Can you help us?
Oh, you have an hour? Can we talk about this? Whoever asked it? I think, I've been racking my brain, right? What could have been done differently? And I think one thing, and I've also read it, to be quite honest, that maybe the scenarios that they were developing could have been different, or maybe they didn't think about the impact of like a rising interest rate scenarios. I think they thought interest rates were going to go down. That's why they undid the hedges. They let go of that insurance they had. But they should have actually did the interest rate rising and really thought, okay, if interest rates do go up and this happens and we have to report these losses, what happens? So I think the scenario development, maybe I would be interested to see what they developed in the conversation and the risks in the ALCO committee about interest rate rising scenarios.
Okay, thank you so much for the explanation you've given. Another question you want to find out is who should develop the risk scenario? In one of your presentations, you spoke about developing risk scenario. You want to find out who should take charge of developing this risk scenario, if you can.
Well, as I said in the presentation, it'd be nice if there was a committee formed, which maybe had a senior manager that also included, the risk team and even some business line managers, head of different products to come in. Okay, that's best case scenario. I have found that a lot of institutions, the scenarios were developed by the risk person, or the risk team, and then they'll be presented to some senior managers who will give some input and to the board. So again, I have best case scenario, a committee develops it. Most likely is risk team, and then goes and talks with different people to see if they come up with some different scenarios.
Okay, so you are saying the person or the group of people should be in charge is the committee, the risk team, the senior management, and then further on to the board. Is that correct?
In the best case scenario, in reality, I've seen most of the time it will be the risk team developing the scenarios, but then getting input from others. Okay. Because it's hard to form this committee sometimes, I find.
Thank you for the clarification. Another question, please, you are encouraged, if you have any question, you can post it on the chat box, and then Donna will attend to all questions for us. Now, Donna, quick one. How often should a strategic risk scenario be reviewed? How often should this scenario be reviewed?
Oh, if you would have talked to me 15 years ago, 15 before the crisis in 2009 and before pandemic, before rising interest rates environment, I would have told you, oh, look at the scenarios every few years.
Okay.
You know, we just didn't have these significant shocks like we've been having in the banking industry and the financial industry the last since 2008-9. So now I think they have to be looked at probably annually to really consider how things have changed. Yeah, I think they need to be looked at annually.
So you recommend we look at it very often from time to time?
Annually,
Annually,
every
okay.
year, annually, minimum
okay.
annually, yeah, minimum
Okay.
annually.
Thank you. There is a question being asked from the attendees. It says, who are the risk owners in a strategic risk? Who are the risk owners in strategic risk?
Oh, well, that, you know, the owners would be probably the at the end of the day, it has to be the board, right? The board owns everything, you know, but in actually oversight and monitoring, it would probably be your risk committee and your risk department. If you don't have a committee, maybe you have a risk department. And if your risk department is doing it, or in your senior managers. So it'd probably be, I mean, I would say first is your management risk committee, if you don't, and second would be your risk staff and your senior executives.
Okay. So these people own the risks. Now, another question from the attendees is, can the government policies be listed among the strategic risks?
Yes.
Government policies. And if yes,
yes.
how? Can you go further by talking about how?
Oh, you know, so this is an interesting question. I have an institution I'm working in Bosnia, and this is the most overregulated country I've ever worked in. And every year they're just creating regulations that are just weighing down the institution. And I think you need to include it as a scenario, like if they're going to implement, you know, certain restrictions that require, you know, require you to hire another person in compliance, or require more money to implement. You know, you just have to come up with the scenarios and how you, like, in the financial impact, you know, if you can estimate it, what would be the low, medium, high. I mean, most recently in Bosnia, it's made all the financial institutions, even the tiny ones, have had to hire another compliance person because of the anti-money laundering that they're implementing there. So you put it as a risk factor, and then maybe put it as, you know, that the regulation is recommended or implemented, you've got to figure out the impact to the institution and how much that's going to be, and then decide is it high, medium, low, and then if it's a medium or high, it's going to be discussed probably with the board.
Thank you, Donat. Yeah. It's been a good series we are having, and this particular one is very, very instrumental to our organization. Now, another question comes in that strategic plans are mostly medium to long-term visions of the institution. So how is short-term disruptions be dealt with in the light of long-term plans?
Well, good question.
Yeah.
So you need to think about these high impact things that can happen to your institution that would shock the institution. For example, what happened with the Silicon Valley Bank, the run on the deposits, how that shocked it and forced the regulator, well, it didn't force, but the regulator stepped in, or like an earthquake, an environmental. So you have this strategy, right, that's being implemented. And what would stop the strategy from being implemented is one of these short terms. It could be a short term, it could be a shock, could be something that shocks the entire banking environment, right? Or shocks the, you know, for example, in Ghana, I know that there has been the discussion of the repricing of your bond portfolios, or what's happening with the government talking about the bond portfolios. I mean, that's going to be a shock to your institutions and something that needs to be thought about. Some of these things you can't plan the scenarios, but when you do the strategic plan, it helps you think about how am I going to react to these shocks in my environment or to the institution really quickly.
Okay. some bit of clarification in your presentation. You said, if I got to, you said corporate deposits are less sticky than retail deposits. Is that a cure for using short-term funds to fund long-term assets? That this mismatch continues to cause challenges for many financial institutions. So is that what you're trying to say, that we use short-term funds to fund long-term assets? Can you clarify it for us, please?
Yeah, that's what I'm saying. I mean, that's what one of the major things that's come out of Silicon Valley Bank is that they use these non-sticky deposits. And I think we talked about last week, that how you have to assess what your sticky deposits are, and smaller that are underneath the insurance allowable amount, which in the US is $250,000. That's quite a lot of amount for personal people, but for companies and corporations, it's not, who may have huge amount of deposits. So personal deposits are sticky, meaning they're lot less likely to move with interest rates or something happens in the environment, whereas corporate deposits will move quickly. You can figure out usually the average amount of consumer deposits that are going to stick around, that have always remained consistent in your institution, and they can fund longer term. I'm not saying 30-year assets, but you can fund longer term assets, 3-5 year assets, with those sticky deposits.
Okay. Now there is a more personal question for we in Ghana. I say that, can the failure of a country's economy be attributed to the country's failure to manage its strategic risks? Yeah, that's what I say, it's more personal.
Nathaniel, maybe you should be answering this more than I am. I mean, it breaks my heart when I read the information on Ghana, when I started researching, and the decisions that were made, had to be made to stabilize your economy, and how many people personally were affected.
Yeah.
And yes, I would say it was a strategic risk in your country, what was being decided by people that were leading. Oh, I better be careful. Sorry.
Please, if there is any follow-up question, you are encouraged to post it in the chat box, and then Donna will attend to us. So Donna, a quick one for you. What is the best way to monitor strategic risks? The best way you recommend for us to manage strategic risks?
So I think you have to have some key strategic, some strategic risk indicators that you can base on your scenarios. I mean, one indicator could be a natural event. If a environmental natural event like an earthquake or a flood happens, like in this country I work in, it would trigger the financial institution have to quickly assess what you think the financial impact to the institution and to the clients will be. And to financial impact in the institution can be, if our branches are flooded, what we're going to have to, what equipment was lost, but also then the impact on our loan portfolio. And what clients are going to have a hard time. So that's the intolerance levels then also. So if you're looking more at the strategic plan of an institution, like portfolio growth, you can again have these indicators of looking at your growth. And if you're not hitting the growth, and let's say the portfolio actually goes down, what happened to one institution I work with, they were supposed to keep growing. And guess what? A couple of their larger loan clients found cheaper money because they weren't the cheapest in this market, and their loan portfolio actually took a dive last year by 10%, which impacted their income statement. So that was an indicator that their strategy wasn't being implemented as they had planned.
Okay. So in your presentation, you made mention of strategic key risk indicators. Now the question is, what are the ways a financial institution can follow in achieving a high liquidity portfolio in relation to selecting a best risk key indicators?
Okay, I'm Frank, I'm just trying to make sure I understand this question right. The way I can follow and achieving a high liquid portfolio, highly liquid in relation to selecting the best key indicators. So I think when I did last week, the liquidity presentation, and if you don't have it, I'm sure you can contact Nathaniel and he can send that to you.
Yeah.
I did give a bunch of key liquidity indicators that would help you think about your liquidity in the short term and the long term. I mean, a cash liquidity, of course, is the biggest indicator of liquidity, or cash or investments that can be, be made into cash within 3 months. And I think to answer that question, it'd be best to get that presentation, and you can look at the key liquidity indicators that I put in that presentation.
Okay, thank you, Donald. So based on what Donald said, you can check on our website, gamfin.org. All the webinars we've had were recorded and posted there together with the materials Donald gave unto us. However, this webinar is also being recorded, and Donald has given us a lot of materials to be given onto you. So as we end this webinar today, you will receive an email with the materials and a link to this recording so that you can have access to it. Thank you so much. Donna, can you go to the last slide so that we can have the final series? So this risk management was a series of 4 parts. The first one was asset liability management, which was the ALCO. And then we had the liquidity risk management. And today we are having strategic risk management. And then the last one on this series is the effective risk management, coming off on the 4th of April, 2023 at 1 p.m. You can register it so that it is on your calendar and then you can make time for it. Thank you. And with that, if there is no question being asked, we'd like to end the webinar here. Oh, sorry. So a quick question, Donna, just came in before we ended. It says, from the presentation, I understood that strategic risks has small but longer impact. Are there any leading indicators or strategic risks materializing? The risk indicators still appear to me to be lagging indicators. Can you attend to this question for us in a short while?
Are there any leading indicators? Because you think it's lagging indicators. That's oh, you're a smart one. Who asked this, Emmanuel? Yeah, leading indicators that are not like financial or can be an indicating of something that has already happened. I'm trying to think, and you know what, I may need to come back with you on that one, because that's a very good question. So maybe, Nathaniel, I can come up with that question later and we can send that question out or put it on the platform so people can see my answer.
So I'll wait for an answer, and then I'll add it to the materials to be sent to the participants, if that's okay.
I promise to do that. And Emmanuel, you get a big star for asking this question that is making me think hard.
Thank you, Donald, and thank you everyone for joining today's webinar. And with that, we'll be ending the webinar right now. Thank you and have a good day.
Thank you.